The purpose of this video is to discuss the recognition or the standard on revenue recognition from contracts with customers. This standard is more commonly referred to as the revenue recognition standard. And even though this standard is somewhat recent, it doesn't mean that we did not have, US GAAP did not address revenue recognition in the past. But what the motivation behind it, or the motivation of coming up with this new standard, stemmed from the fact that we had several standards that indirectly address revenue recognition in the past, and as the number of those standards grew, we sometimes would find inconsistencies within the message of each standard. It was to the point that it resulted in a high frequency of restatements related to revenue recognition issues. So there was a motivation to come up with a more broad standard that would have a more general application. In the past, and this is here where I'm saying the old days, in the past the idea was based on the idea of revenue recognition was based on whether you had earned that revenue and whether that amount was realizable. So the approach taken in the past was more about defining the revenue itself, whereas with the new revenue recognition standard, the idea is more about making sure to define what the rights are or the obligations are under a contract. And I know it doesn't sound like a big difference, but what we're aiming at here is saying whatever rights arise from a contract, those are the assets that we can recognize and indirectly recognize revenues for that. And the same thing here with the obligations. Any obligations that arise from a contract, that's what we owe in terms of, or the liability that we have from that particular contract. So instead of looking at it from an earned and realizable approach, the new revenue standard is looking at it more from an asset and liability approach. And it doesn't have to be complicated. As I state right here, if you initiate and you complete a transaction at the same time, then it's simple. There is a service provided or a product given, and payment or consideration for that item is received, and the transaction is fully completed, and the seller can recognize the revenue for that transaction. So that's not complicated, and that's still the same. Where it gets a little bit more complicated is if you bundle products or services as one contract, or if you also allow for payment options like long-term financing. So when you have things like this, then the issue of revenue recognition becomes a little bit more complex, because if you have different things being bundled up into one, then how do you determine what part of each one can you recognize of revenue? When you have financing available, what component can you recognize of revenue? And those are the things we got to think about. So under the new, or just the revenue recognition standard, there's 5 steps that we need to consider in order to get to a point where we can recognize revenue. And the objective here is just to recognize revenue based on consideration exchanged. And when I say exchanged, that consideration is based on either what you receive or what you give. Okay, remember that we can always value a transaction based on either one of these inputs. I can value the worth of an exchange based on either what I receive or what I give, or both. So here are the simple 5 steps that need to be done. The first thing that we need to do is explicitly identify what the contract is. Okay, and once we identify what the contract is, then we know the parameters to use in terms of what will potentially be recognized as revenue. Then we need to, and by the way, I'm going to go into details on these 5 things, but let's just kind of talk about them real quick. The second step is to identify if there are any separate performance obligations within that contract. So remember when I gave you this little sample here, I said if it's just one simple transaction that occurs at the same time, then you probably have a single performance obligation. But if you bundle stuff together, then you might have separate performance obligations, and that's what we need to look at very carefully under the standard. Then the next thing is to determine what the price or consideration of this contract is overall. And then once we determine that amount, again, based on what we receive or what we give in terms of value in the contract, then we can decide whether what amounts go to each SPO, what amounts go to each separate performance obligation. And that's step number 4, by the way, which is allocate that price to those SPOs. And then finally, recognize the revenue as each of those SPOs or those obligations, those performance obligations, are satisfied. And as a side note here, I put, this assumes that the collectability of those receivables is highly likely. Okay, so throughout this process, it really goes back to the old days where we said, well, recognize revenue that is earned and realizable. So in a sense, that still applies. The collectability aspect has to be there for us to be able to recognize revenue. All right, so let's talk a little bit more in detail here about the first one, identifying the contract. So very important to understand that the contract itself does not have to be this formal written document as we may envision. Okay, it could be oral, or it could be simply implied from regular business practice in that industry. So, if you go to a fast food restaurant and you give them X amount of dollars for a hamburger, there is no written contract, but it is implied that when you hand your money, you are going to receive a product from that company. And that's just the way that is customary for that business, okay? So please understand that we are not talking about, we may or may not be talking about a formal contract. So what are the components of having a contract? The first thing is that contract needs to have commercial substance. In other words, the position, the economic position of each company will change based on this contract. The other component is that the parties involved in the contract have approved it, okay? The rights, which are, give rise to assets, and the obligations to each party are identified in the contract. And then the payment terms are identified. And as I mentioned before, it is probable that the consideration will be collected. So if you have these components within that contract, then you have satisfied step number 1. Okay. I do have a couple of caveats right here on the side that I think are important to consider. The first one is the issue of whether you have a contract that gives rise to a sale or not. And that's where we have to be careful, because there are some contracts out there that may appear to be a sale, but technically they're not. So this is note number 1 here, where I said some contracts may not actually be a sale. And this is important to us right now with this revenue recognition discussion, because if you have no sale, you have no revenue to consider to be recognized. Okay, so that's very important. What's an example of this? Consider a repurchase agreement. Okay, a repurchase agreement is where I sell something to party X with the intention of repurchasing that item from party X later on. And while initially it may seem like a sale from my part, because I'm selling this to party X, the ultimate transaction most of the times is just a financing arrangement where I'm just borrowing money. So, think of it as me having some equipment or some asset that I sell to somebody, I get cash, but then later on I buy it back. So it's like having an asset that you use for collateral for a loan. In that case, when I sell that asset, I debit cash for the amount, but I won't credit revenue. It's not a sale. And that's what I'm trying to get you to see. It would just be a plain old liability if the transaction in substance is a loan. Okay? So a little bit more details on this because it might seem a little far-fetched, but these are actual arrangements that are done in business. If the seller, in this case myself, let's say, has an unconditional forward obligation or call option to repurchase it. So I have to repurchase this, right? In the sense of the forward obligation, or I have the option to repurchase it later. So if the repurchase amount is greater than the sales price, so let's say I sell it for $100 today, or in other words, I borrow $100, and later on I repurchase it for more than $100. Then what you can see here is that basically I used, like I described right here, I used that asset as collateral, and when I pay later on more than what I sold it for, I'm basically paying interest or financing costs. So in those cases, that's exactly what I was referring to. In those scenarios, you are treating this as a financing transaction and not a sale. On the other hand, if the repurchase amount, what I pay, is less than the sales price, then most likely this is going to be a lease and will follow the lease accounting rules. So again, neither one of these is an actual sale. Now, if the buyer has a put option, let me spell this correctly, to make the seller repurchase. So if the buyer can force me to resell it and the buyer has an economic incentive to return it, then at that point, once again, it's a financing transaction. So in other words, the economic incentive that may exist to the buyer is that I would be buying it back at a higher price than the fair market value of it. So, similar to what this A is referring to. So if I'm buying it and there's an economic incentive from the buyer to sell it back to me, then again, that's just an extra amount I'm paying that really seems like a financing arrangement. On the other hand, if the buyer does not have an economic incentive to return it, and here I'm saying the asset might be worth, let me make this a little smaller here. The asset might be worth more than the repurchase price, so they don't really have an economic incentive to sell it to us. Then at that point, we may treat this as a sale of a product with the right to return. And if you have, and we'll talk about this a little later, if you have a sale of a product with right to return, then you must be able to estimate what the probability of return is in order to recognize revenue at that point of sale. So this would be the scenario where it might be a sale, but then it's a, with a right of return. But the big picture here is that I'm trying to get you to see that just because you have a contract doesn't necessarily mean that it's a sale, okay? So make sure you are a little questioning of these things if it doesn't seem like a sale. In accounting, we value substance over form. So even though you might have a contract that says sale of something that's in form, if in substance it just looks like a loan, then that's the way we're going to treat it, as a loan. That's the first thing I want you to be careful with. Second thing is, sometimes you have what is referred to as a principal-agent relationship. And what's important here to recognize is that there's three parties involved in a principal-agent relationship when it comes to the sale of goods to customers. You have the seller who hands their product to an agent. So the seller here would be the principal. And then they hand this their product to an agent, that's the second party, who eventually sells it to a third party. So the agent is just the middle person. And what's important to realize here is that the principal is the one that recognizes the revenue on the sale. The agent just recognizes a cut or a commission on that sale, or whatever the fee is that they charge. And the reason why this is of importance is if you are under a principal-agent relationship, you are doing the accounting for the agent, let's say, you got to be sure not to overstate your revenues. Your revenues are not the sale amount. Your revenue is your commission. The revenue of the principal, that's whatever the total is minus the fee that the agent costs. That's who's recognizing the revenue from the sale. And For you to determine whether you have a principal agent relationship, you need to meet these five requirements here. Okay, so if you are in doubt, then here are some of the things you need to check. If the other party, not the agent, so another party is responsible for fulfilling the contract, that's one of the items that would imply that you are an agent and not necessarily a seller. So in other words, it's another party who is going to do the work. You're just the middle person, or the agent is just the middle person. The agent, if the agent does not have asset risk, okay, if it's somebody else fulfilling the contract with the assets, then and you have no asset risk, then that is another indication that you are an agent. You're under a principal agent relationship. If the agent does not control prices, okay, it's the principal that controls the price. Let's say if you're just the middle person not controlling the prices, that would be another attribute. If the consideration that the agent is to receive is simply a commission, and finally that the agent does not possess credit risk to the organization or responsible for fulfilling the contract. So in other words, they're not the ones that are assuming the payment risk. They're just the middle person. It's the person that fulfills the contract with the principal, and then the principal, or I'm sorry, I might have said this backwards, but whoever is the person that is supposed to pay the seller, the agent is not assuming that responsibility or that risk of non-payment. Okay, so if these five requirements are met, then you have, in this case, a principal agent relationship with which needs to be treated as such. So let me give you an example so you see what I'm saying with that. Sometimes these things seem a little bit more complicated with all the details than just a simple example. So what's your typical principal agent transaction? When you use when you sell goods on consignment. Okay, so when you sell goods on consignment, you have the manufacturer or the person trying to sell something. We'll call that person the consignor. Okay. And then the middle person would be the consignee. And then you have a third person, which is the customer, right? And the consignee is the person selling these goods or being the middle person in the process. Or in this case, a consignment store. Okay, they take goods from somebody to sell, and if they don't sell them, they give them back to that manufacturer or that person that wanted to sell them. So the goods, once the goods are transferred to the consignee, there's no accounting because the goods remain in the consignor books. So it's just a physical transfer of assets. Now, on the date of sale, the consignee is going to receive money from a customer, okay? And then immediately that is a liability that they have to the consignor. All right, the customer gets the asset, whatever asset that may be. And immediately the consignor is informed about this. So at that point, the consignee, try to follow here with the the tongue twister here, consignee, consignor, hang in there. So once we immediately pay the consignee pays the consignor, you reduce that liability for X amount, the full amount of the sale, but the consignee is going to take a small portion, which we're going to call this Y. And the cash that is sent to the consignor is X minus Y. So the full amount received from the customer minus whatever the commission is. So that amount right here is what goes to the consignor. Let me put a little color on this, make it easier to follow. So the consignor, the manufacturer, is going to receive the net amount, and they're going to account for that commission that they pay to the consignee or the agent as well. And then this is their revenue. But here's the big thing that I'm trying to get you to see, okay? And this was the caveat I was trying to get you to be careful with. If you are under this relationship, okay, the principal agent relationship, it is the consignor that records the full revenue amount, okay? Notice that the consignee does not recognize the revenue X. What they do recognize is a small portion of revenue for their commission, and that's how it should be. Okay? And then, I just add here that, if the consignor has cost of goods sold, or the cost of that item needs to be removed for Z amount, whatever that may be. Okay, so that's the first step. And I know that was a little painful there, but that's part of identifying the contract, making sure you have those attributes that are needed, and making sure that you're being careful when, even though you have a contract, you may not have a sale, or if you have a principal agent relationship, that you make sure that if you are the agent, you are recognizing only your commission revenue, not the full sales price. All right, the second item on the 5-step process involves separating or identifying the separate performance obligations. Okay, so what are the different things under this contract that we can break apart and decide how revenue will be recognized? So let's go to step number 2 here. Let me space this out, that way we have some clarity here. So under step 2, identifying the separate performance obligations, you have to ask yourself whether you have a single performance obligation. And I guess we could just start here first, okay? If you have a contract and there are items within it that you cannot sell separately, either a product or a service that, it's just part of one single contract, then at that point, you don't have separate performance obligations. The amount of the contract is the whole thing. And that's the revenue that we're thinking about, whether it gets recognized or not. So for this to be treated that way, we need to make sure that each product or service is interdependent or interrelated to the whole contract. And a perfect example of that is if you buy a car and you get a warranty that comes with the car, it's included as part of the sales price. That warranty is interrelated to the sales price of that car. So that would be a single performance obligation. You would not account for that warranty as a separate performance obligation. Now, it doesn't mean that you do not estimate part of the expense that you might incur. Okay, so you still have to recognize revenue up to the amount that is you think you will earn, and part of that amount will be unearned revenue until the warranty period expires. But nevertheless, what we're saying is that is one single amount transaction. We're not going to separate it into different components. How does that differ from SPOs? Well, if under the contract you can identify products or services that you could sell separately, easily, okay? In other words, each product or service that you are looking at is not interdependent or interrelated to the product. It's not part of the sales price, let's say, like it was in the car example here. Well, if that's the case, then under the standard, you have to separate those different performance obligations and account for them separately. Now, what's a good example? The extended warranty that you may choose to buy, may or may not choose to buy. So if you buy a car, it comes with a warranty. You can't get rid of that warranty. That's just what it comes with, all right? That's this one here. Okay, good. That's part of one single performance obligation. But if on top of that you decide to buy an extended warranty, then from an accounting perspective, we can separate those out. It has a value, and we're going to treat it as a separate performance obligation with different criteria for satisfaction in terms of revenue recognition. Okay, so that's the second component on identifying the separate performance obligations. Ask yourself those questions, and that'll help you determine whether or not you have SPOs, or if it's just a single performance obligation. All right, third item to consider now in the 5 steps in order to, under the revenue recognition standard, the third step is determine the price of the contract, the consideration. And while this may seem straightforward, there are some issues that need to be considered. So let's think about those issues. Let me move this down. So you might have a contract that spells out the amount, so that, and no issues may arise, and that's fine, okay? And many times that's the case, but there are some items that make this point a little bit more challenging, right? So what do I mean by that? Often you have situations where the amount is variable, okay? The consideration of that contract is variable. From what? From many things, okay? From potential changes in prices, potential discounts or rebates that might be applied, credits like returns, any royalties or any extra amounts that might be paid based on some level of purchases, okay? And what that ends up doing is that it makes the amount of the contract, the price of the contract, variable. And if that is the case, then we need to come up with a systematic approach of how much it is that we're going to use in terms of the value of the exchange for this contract. And what we'll do is we'll do a calculation of what the expected value is. And we'll do it using probabilities. So, and this doesn't have to be complicated, okay? Just so that you understand what I mean by this. You know, this could be something where, let me include a little arrow here so you can see what I'm saying. So you might have a scenario where under one scenario you get $100, under another you get $110, and then under another you get $120. And the probability here is 20%, probability here is 60%, and actually let me make this one 70%, and then this one 10%. So we use the expected value amount from each one of these. So this will be $100 times 20%, which is $20, and the rest of them will sum up as follows. So when you do this, you sum it up, and we would say that the expected value from this contract based on this probability assessment is $109, and that would be the price or the consideration we would use for the contract. That would be if you're using an expected value approach. If you only have a couple of outcomes, you could just use the most likely amount from those two potential outcomes. And I have a note here that this process, you know, this process that I just described right here, well, it may seem, you know, straightforward mathematically. Here, let me clean this up a little bit. There we go. While this may seem straightforward mathematically, the real issue is not so much coming up with these amounts, but it's more about the probability assessment. So what I say here is that it's important that you have experience. That for us to be able to use this approach, we must have some experience and the ability to estimate. And if we don't, what I mean by that is that a business must have gone through this in the past. If you're just, you know, starting out, and this is something that you're not used to having a contract as such, that type of transaction, then you might not have the experience required to come up with a good estimate. And if that is the case, the revenue recognition might be constrained or delayed until you fully realize that amount or you have known probability assessments. Okay, very important. So just because we do a computation doesn't mean that that's something that we can start considering for revenue recognition. We must have the experience and know-how to do it in order for it to be useful. Okay, so that's one consideration that needs to be looked at. The other one is the time value of money. So if your contract amount involves significant financing, a significant financing arrangement, such as it being more than 1 year, then we need to use the present value of the future cash flows or the fair market value of the consideration received, whatever is more evident, right? This goes back to the idea of you can value the transaction based on what you give or what you get. So the idea is you can do a present value of future cash flows, or you can use the fair market value of what is received by the customer, whatever is more evident. But in any case, the idea here is that you need to take into account the time value of money for periods over a year. And that again can affect the amount or the price of this contract. If you receive non-cash consideration, okay, this is non-cash consideration, then how do you value what you get? Again, we go back to using the one that's more evident, either what you receive or what you give. But somehow that non-cash consideration plays into the amount of the price of this contract. And then the other thing that we need to consider is non-refundable upfront fees. So if prior to this contract actually starting out, you have some fees that are charged, and the contract goes through and everything goes well, then those amounts need to be allocated over the whole period of the contract. Again, this is going back to revenue recognition. So you're not going to recognize the whole revenue at once for this. It's going to be over the period of time. Okay, so that's the third item. So far we've talked about the importance of identifying that contract, whether that contract is written or oral or implied, being able to identify if there are separate performance obligations or if it's just a single performance obligation, and the issues to consider with respect to the price of the contract. So now let's talk about allocating the price to each separate performance obligation. That's number 4. And I'm just going to quickly say that with this, you can use, like anything in accounting, like with anything in accounting, we can use different approaches to allocate, to estimate any value, okay? And as long as it's systematic and rational and we are consistently using it, then that's fine. Now, one of the best ways to allocate this is to use a relative fair market value method. So in other words, maybe we have 3 services that are being offered: service A, service B, and service C. And the whole contract is for $100. Okay. Now, the fair market value of each one of these is, let me align this. So again, just to be clear, I'm illustrating, how we would allocate this under the relative fair market value method. Okay. You've seen this approach before, and I'm just going to illustrate it so that you understand that it's not a weird method. So if this is, maybe this is worth 50, this one's worth 60, and then this one's worth 30. Okay, this sums up to more than $100. So how do we allocate $100 for each one of these services or products that we're selling? And we use the relative fair value of them. Okay, so what we'll do is we're going to say percentage or weight. So right here, we'll go in there and say this is, wait a second. Let me sum up the bottom here. So I'm going to go in there and say 50 out of 140 represents the weight, or 35%. Same thing here, 60 out of 140 represents this amount. And for the sake of completion, I'm just going to do this last one here. Oops, that doesn't look right. Sorry. There we go. So these weights are what I'm going to use to allocate the $100 to each separate performance obligation, ABC. So in the first scenario, I'm going to go in here and say, okay, 35% of this, 35% of the $100 is what goes to SPOA, which is 35 bucks, okay, roughly. And same procedure will be used throughout here. So that when we allocate things in that manner, we will be allocating the $100 of the contract that we initially agreed to, okay? And that's the important thing. So, you know, just any method that would work, like the relative fair market value method I just used right here, gives you the amounts that will be for each SPO. So revenue for each SPO, that's the amount right there. Now, you could use other approaches like a cost plus margin approach to estimate. So if you have $100 contract in each SPO, you could estimate the cost of it and then add some profit to that. Or a residual approach where maybe you know the estimate for A and B, but you don't know the amount for C. So you estimate A and B, and then whatever remains, the residual, you allocate to C. It doesn't matter. It's got to be simply some method that has some form of reliability, okay, and that we apply consistently. Okay, finally, we get to step number 5, which is, okay, now we can recognize the revenue. And if you notice, this is making sure that all these attributes that define rights and obligations are in place before we start looking at whether revenue gets recognized or not. So let's look at number 5, step number 5. So the first thing that I'll mention is that for each SPO, we're going to recognize the net revenue, okay, the amount that we reasonably are assured to be entitled to. So this goes back to this idea here that we discussed, where if you have variable consideration, then you're going to use the expected value from that amount as the revenue to consider. Okay, I don't know if, I think we discussed it here. So for example, when we were talking about the repurchase agreement, and you have a buyer that has the option to make the seller repurchase, if the buyer has no economic incentive, then you can treat it as a sale with a right of return. So this right of return would make it a variable consideration amount that you would have to consider for purposes of step number 5. What's another example? Sales returns and allowances. So notice how through sales return allowances, we need to incorporate that net amount as the revenue recognized. And here's something real important, okay? And this I mentioned before. If you cannot estimate the returns with reliability, in other words, if the variable consideration is you cannot estimate that variable consideration with reliability, then you are not allowed to recognize that revenue until predictability is more reasonable. Okay, and that's very important. So here's an example. I sell something, so accounts receivable and revenue goes up by X amount. I have, or these are just a whole bunch of sales. I have some returns from customers. So I debit sales return and allowances for Y and credit AR to those customers, put that back in inventory and reduce cost of goods sold at cost. All right. On the financial statement date, if I don't do this adjusting amount here, if I don't do this adjustment, then I will not have revenues at the net amount. So whichever way you do it, this is doing it on the financial statement date before information goes out. I will estimate what amount of returns from these sales X might still come in. And that's where you have to be able to estimate it with some form of reliability. So I am saying that I think we'll still have Z amount of returns apart from Y. We already had Y. So Y plus Z is the total amount of returns I think are related to X sales. So I'll debit sales return allowances, and I will actually create an allowance for the sales return allowances for that Z amount. I will estimate how much inventory is going to be returned. This is just an estimate. And I will credit cost of goods sold. So this here is a contra accounts receivable account because I don't know specifically who I am crediting for those returns at this point. But the point here is that I said, okay, what can we recognize now once we satisfy an SPO? we can recognize the net revenue. And if you have issues of variable consideration like sales return and allowances, then you need to incorporate that in there so that you can reduce revenue. In this case, sales return and allowances is going to reduce revenue for the amount that you think would give you net revenue. All right, the other thing is this. So the first item in terms of recognizing revenue is recognize the net amount. We're clear on that. But then the second component is we recognize that net revenue when change in control has occurred. Okay, so change in control in layman's terms means you sold something to somebody and it's no longer yours. Okay, the buyer is in control of that asset. And if that change in control has occurred, then we're at a point where we can recognize revenue as a seller. And here are some attributes that might indicate that there's change in control. And by the way, this revenue recognition is for each separate performance obligation. So each separate performance obligation will be recognized slowly. In terms of long-term contracts, this is a process that is done slowly. So what are some indicators that imply change in control? The seller has the right to payment. So once I hand this asset to a buyer, I have the right to receive payment. Legal title has transferred to the buyer. Physical possession has transferred to the buyer. The buyer now has the risks and rewards of ownership of that asset. And the buyer has accepted that asset. And by the way, this is not a list where you have to meet all this criteria. No, but these are indicators that imply that that asset that I was selling is no longer in my control. It's now in the control of the buyer. Okay, and that's what's needed to be able to recognize revenue. Now, here's a little note. This is the last thing I'll mention here. Here's a little note. There are arrangements where some of these attributes have not been met, but we might be able to recognize the revenue. And more specifically, it's with build and hold arrangements. So sometimes you have a buyer that'll buy something from you, but they'll ask you to keep it, to hold it. For whatever reason, they might not have space. They might have bought too much inventory and they're under contract to buy more. They're under an arrangement where they have to buy it. So they may ask the seller that, they're basically making the purchase, but as a favor, they're asking the seller to hold that, not ship it yet. So if you think about it, if you're under a bill and hold arrangement, then these attributes right here have not been met in terms of change of control, right? Because physical possession has not been transferred. Technically, the buyer, doesn't have possession, so it's hard to say whether they have the risk and rewards of ownership, and the buyer has not received or accepted these assets. So in those scenarios where we have a build and hold arrangement that is being done as a condition to aid the buyer, we can still recognize revenue, but we need to meet 5 criteria, okay? First of all, the conditions for change in control have been met, with the exception of the ones I just mentioned. So, I have a right to payment as a seller, legal title has transferred, and so those are met. The reason for the buy and hold is a substantive reason, okay? It's not just for, there is a legitimate business reason for that. From the seller's perspective, okay, I have to be able to separately identify that product for the buyer. So in my warehouse, there has to be a section where it's separated, and this belongs to buyer X. We're just on a build and hold scenario right now. That product is ready to be physically transferred to the buyer upon notice. And the seller cannot directly sell that asset to another customer. Okay? They cannot. So what we're saying here is this. Let's keep this in mind. You can recognize the net revenue when change in control occurs. Okay? We defined what change in control might be. And then now I'm describing this scenario, build and hold arrangement, where it's doubtful whether change in control has fully occurred. But nevertheless, this is something where the seller has, for the most part, complied with their part of the arrangement or the deal. So in those scenarios, we say, okay, if the seller has mostly complied under the original contract, with the exception of a build and hold arrangement, then you can recognize revenue as long as these conditions here have been met. And we're basically saying, if you're holding that inventory, make sure that we can identify that inventory truly as belonging to one buyer. And if that's the case and it's being separated, and at that point, the seller can recognize that revenue. Okay, this concludes the video on revenue recognition standards. It's a lot of rules that we need to really be careful with. It's, in the past you may have thought of revenue recognition mostly as just determining the amounts, which is part of what we do, right? We got to determine these amounts. We got to determine the net amounts as well. But it's also about making sure that we identify that contract and that contract is for a sale. And that under that contract, we separate whatever obligations, performance obligations need to be done. And that's the big deal now, because again, we're aiming with the revenue recognition standard to define the assets and the liabilities, the rights and obligations under those contracts. And indirectly, that will define what revenue can be recognized.